I think value probably outperforms growth in 2024. But it's not that we don't want growth exposure. The way that we're looking at growth in this year is we want a broader exposure, right? I don't want to go overweight those 7 names that are wildly elevated inside the price to earnings ratios. And I'm not saying we don't own them, right? I think owning them is still relevant. And
you just don't want those 7 to make up 25% of your portfolio.
I don't need them to dictate the entire role of my portfolio behavior in 2024.
Starting your route to retirement.
Welcome to the Guided Retirement Show. I'm your host, Dean Barber. Back for the 8th time is Brad Kasper. He's the president and founder of LSA Portfolio Analytics. I hope you enjoy my discussion with Brad as we recap 2023 and we give our predictions for 2024. All right, Brad Kasper, president and founder of LSA Portfolio Analytics. Welcome to the Guided Retirement Show. This is your 8th time joining us here. Last time you were on was August of 2023. We discussed monetary policy. We discussed the Fed. We discussed, whether we were going to get into a soft landing. A lot's happened since August of 2023. So welcome back.
Thanks, Dean. As always, it's a pleasure to be here and can't wait to talk more monetary policy and start to look a little bit forward into 2024.
We had some pretty crazy things happen in 2023. Let's recap that first, and then let's get into some predictions for 2024.
Sure. So let's go back into 2023 and really set the stage of what most people were thinking was going to happen throughout the year. Most people believe that halfway or towards the end of the year, the Fed was probably going to be done raising rates and probably start cutting rates. And
they got the first half right.
They got the first half right. And we were never really in that camp, right? We thought the Fed would be engaged for a period of time and probably second half of 2024 is the earliest that we may see the Fed start to cut rates unless there's a catalyst that starts to change some of that. So we think some of the optimism around rate cutting was a little bit premature in terms of the call. So what did that do? Well, throughout the year, as they continued to raise rates, bonds were still under pressure for the majority of the year. And then all of a sudden, we get to the last quarter, you start to see the softening of the tone of the Fed, suggesting that we're probably at the top of the rate hiking cycle. And what happened? Well, equity markets started to pick back up into the tail end of the year. You saw bonds really started to rotate because keep in mind, at one point, the 10-year Treasury was right at about 5%. And then we ended the year closer to about 4%. That's a pretty significant move on bonds, which all of a sudden gave a little bit of credence to like the Barclays U.S. bond ag. So everybody that's been just wildly, upset at their bond behavior and performance saw incredible bond performance in a short window. And as we start to look forward, I think what it does is it starts to provide a little bit of optimism around certain asset classes. And I know we're going to get into, talking about those asset classes and some of our thoughts for 2024. And I'm really excited to kind of dig into, where are the opportunities today?
So here's what I observed. And by the way, I was on the same camp as you with no way the Fed was going to cut rates in 2023. I still think it'll be second half of 2024 before we see any cuts. But let's talk first about the bond market because I think it tells an interesting story. We began the year with the 10-year Treasury at 4%. We touched 5% intraday October 18th, and then we finished the year under 4%. I think it was like 3.9 something. Here we are in early January. We're right around that 4% mark. Bond aggregate last year through October the 18th was in the negative territory, wound up positive about 5.5% for the year. And so you saw a huge rotation in bonds. An even better story, I think, is in the municipal bond market. So for people that have money in taxable accounts and are looking for tax-free interest or tax-free income, something happened in 2023 that we haven't seen in over 20 years. You were able to buy high-quality AA+ municipal bonds at or below par value. And we haven't seen that in so long. You go back to the beginning of 2021, those high-quality municipals were trading at 10 to 15, maybe even 20% premiums, depending upon the duration of them.
Right. Yeah, and you started to see opportunity like that across the broader bond market in general, right? So here's the thing is when you got into 2023, the first about 6 weeks, bonds were taking off. And all of a sudden, everyone's sitting there going, oh, shoot, did I just miss the opportunity to step into bonds? And are they back to kind of the behavior of cycles past? Because keep in mind, 2022 came off of one of the worst years for bonds, arguably in history. And the optimism wasn't there. Well, all of a sudden, the fundamentals for the fixed income market started to look more attractive. And early in the year, there was a lot of action that was allowing bonds to do quite well. But then all of a sudden, we sat there and said, okay, slow down just a second, because inflation's not fully under control. The Fed's not quite done raising rates. There was still some pressure that the markets had to contend with. And as we went through that, that's where we found that intraday high on the 10-year at about 5%. But what's interesting, Dean, is, for the last 2 decades, right, we've been sitting here going, man, I miss the days where I could go get a 10-year bond or a 7 to 10-year bond and get paid 4.5%, 5% on it. Well, guess what? We found those types of levels. And when we found those types of rates, it came at a discounted price in the purchasing of some of these bonds. So if I'm doing just simple bond math on the back of a napkin, I'm looking at what's the discounted rate that I'm buying the bond at. And if I hold it to maturity, what am I getting paid over that time? And guess what? We were finding yield to worst profiles in, I'm going to call it intermediate core. Think about the ag, if you will. That was ranging between 6-7%. And that's pretty darn attractive. If we could go back to those years where all of a sudden kind of your safer risk off kind of posturing inside the portfolio is paying you 4.5 to 5%, that's a lot more meaningful, especially when it comes to retirement planning.
Yeah, no, I think that there will continue to be some opportunity there. And, I think maybe my opinion, I'll see what you think about this, is that the bond market overreacted to the Fed, and the yield on that 10-year came down too fast. So I think we're going to see a little bit of a gradual increase on that 10-year here over the next several months. I think we wind up at the end of the year maybe in about the same place that we started the year with that, but I don't think it's going to be just a continued decline. What does that mean for our fixed income investors? It means that what the yield is likely what your return is going to be in 2024.
Yeah, so I think of bonds in the through the lens of coupon plus or minus, right? And so the coupon is what you're getting paid to hold the bonds. The plus or minus is what's the pricing action on the bond markets throughout the course of the year. And I think you're right. I think this year we're probably in a coupon maybe +1 or 2 type of market environment, which suggests there's a bit of a tone there that suggests, 4% is probably a bit range bound, and we probably end somewhere closer there. That's helpful to finding a little bit of price appreciation within the bonds that you're buying. But overall, I think it's a coupon environment, and now that coupons are elevated a bit, that's pretty darn attractive, and that hasn't been for quite some time.
Yeah.
And in fact, last year, if you looked at where all the action was, it was in the money markets. Everyone's sitting there going, why am I sitting in a 5 to 7 year bond when I could go get a money market that's paying as much, if not better?
Yeah, 5% or better. The problem is that that's a daily, and that rate can change daily, right? So the question is, do you want to lock in that return for a longer period of time, or do you want to face going into a potential declining interest rate environment again as we go through 2024, where those yields are going to come back down? One of the things I found interesting is that on October the 18th, when the 10-year bond, 10-year Treasury hit that intraday high of 5%, the 3-month at that point in time was 5.6. Okay, so the inversion of the yield curve had flattened a little bit. But we get to the end of the year, and the 3-month is still at 5.4, so it only dropped by 0.2%, while the 10-year dropped a full percent.
Yeah. Yeah, and I think we're going to continue to kind of see this flattening effect. And not only that, at some point when the Fed does start to raise rates, and remember, the Fed, the overnight lending rate really anchors the short end of the curve, right? That's where every time Powell and company report, they're driving the action on the overnight lending rate. Well, at some point, that has to come down. And I'm not in the camp that it has to happen early, because I don't think we're seeing a reduction in inflation at a pace quick enough that's going to give Powell and the Fed chairmen the confidence that they need to start lowering rates earlier.
Right. I agree with that.
And so what does it mean? Well, it means we're still in probably an inverted yield curve state for a period of time. And, nobody wants to hear this, and I hate to say it at the beginning of the year, but the inverted yield curve has been one of the strongest predictors of recession. And I would argue we still haven't had a full recession. So I think there's going to be a lot of language and dialogue around what does a recession look like in 2024. And when I talk about it, I don't think the depth and duration of the recession are as concerning as maybe some of the cycles of past, meaning 2022, we saw a pretty healthy reset in a number of asset classes. It's a healthy reset in what happened within fixed income, potentially making bonds an attractive asset class as a bit of a hedge against more of your equity counterparts, which we really haven't seen in quite some time. But I think we have to still be somewhat realistic that the indicators that are out there are still suggesting that we have concerns of some type of a recession in 2024.
Right. I would agree with that. Let's stick on the bond topic here a little bit longer, Brad, and let's move away from the high quality and let's go into the high yield. And, high yield was not hurt as bad during the 2022 bond debacle. High yield had a decent year in 2023. Where do you think the likelihood for high yield is in 2024?
So when I think about high yield, we look at spreads, right? We look at high yield spreads over treasuries. And what we're trying to establish is, are we getting paid enough to take the risk inside a lower quality type of bond vehicle? And please keep in mind, historically, credit sensitive fixed income has historically been highly correlated to equity-like asset classes. And so if I look at the last 3 or 4 years, spreads have been fairly compressed, meaning it hasn't been overly attractive to go buy your high yields. And my argument there is, well, if you're going to take that risk, why wouldn't you just go do it on the equity side where you're getting a strong dividend and you're getting a little bit more of the stock type of participation? And until last year, that's been a pretty favorable statement to make. But last year, high yields surprised the heck out of me. Again, this is the funny thing. We're going to sit here and make some calls at the beginning of the year, and they're wildly speculative in in a number of ways. We try to put as much understanding of what's happening with the markets and education around it, but they're still speculative. So when I talk about, last year, the idea that large cap value should have probably outperformed the likes of high yields, and some did at the very end of the year. But throughout the year, high yields remain pretty darn relevant. But my argument is that the spreads still aren't overly attractive. And so for me, I'm looking for more of an event where those spreads widen out, creating a better entry level for that credit. And if I'm going to take credit like risk, I still think that there's opportunities to do that in more of a dividend playing large cap stock that's been around for a while.
Yeah. So let's now, by the way, I agree with what you're saying. Let's go to the broad market, and we'll talk first about the S&P 500 and the normal S&P 500, which is the cap-weighted S&P 500, saw something happen in 2023 that we haven't seen since 1999. And that is that the technology sector of the S&P 500 reached its highest level that we've seen it reach as a percentage of the total value of the S&P 500. Technology sector reached its highest level since 1999. And that was due mainly to 7 names. They were nicknamed the Magnificent Seven last year. And those 7 stocks drove the vast majority of the return. Because if you were looking, I keep using this October 18th date because that was, to me, the magical date when the Fed basically said we're going to pause. At that point in time, the S&P 500 was positive on the year by about 9%. It wound up 26%, which means from October 18th to the end of the year, we had a huge run. Even more surprising, though, was the S&P equal weight. And the S&P equal weight, for those people listening or watching us, is equally weighting your investment across all 500 companies. So you have the exact same exposure to all 500 companies. Well, the S&P equal weight on October 18th was negative 4% for the year, wound up positive over 13% for the year. And from October 18th to the end of the year, the S&P equal weight actually outperformed the cap weight. And so I find that to be pretty significant as we enter into 2024 and try to uncover the riddle of what's going to happen. Where's our opportunity in 2024? So talk a little about the way you see that.
Yeah, so a lot to unpack there, right? So let's go back to the total return index. So roughly about 28% of the S&P 500 total return is represented within a handful of names that are predominantly driven by the technology sector. And throughout the year, the S&P 500 total return has been incredibly solid. And anybody that's running a diversified model is looking at their diversified portfolio saying, gosh, my internationals aren't keeping up, my small caps not keeping up. And so when you look at the total return as kind of your baseline of how are we doing this year, man, you felt like you were wildly underperforming. But again, it was 7 names that was driving over 85% of the return profile within that S&P 500 total return. And we all know the 7 names, right? It's the big tech names, the Amazons, NVIDIA found its way in there, and Microsoft, Apple. We all know the names. And quite frankly, they've been phenomenal names over the last 2 decades almost. And so I'm not here to pick on those names, but I am here to suggest that what we saw in the action of those names and how they drove the returns of that total return index up was a phenomenon that we just haven't seen in quite some time. And so what I think investors need to be aware of is the reality of what that total return really means versus, in your case, the equal weight, which is, I think, a much more realistic pulse. Because what we're saying is 7 names out of 500 are driving 85% of the return. In what world does it make sense that we allow those 7 names to dictate the narrative of what's happening in the overall market, represented of 500 names?
Right. Well, this is why I was going back to 1999, because, you get back into 97, 98, 99, the narrative was the brick and mortars are dead. It's all about the .com companies. And, you go back to your value stocks, your bank stocks, your energy stocks. Everything was performing at a normal rate, 8, 10, 12%, and yet you were getting double digit in some of the technology funds that were back then. You get 100% year, and it's just insane. And then when the house of cards came crashing down, the people that were overweight in that didn't do well. The people that continued their diversified portfolio actually fared okay during the .com bubble.
Yeah, I mean, you're talking about the entry into the lost decade, which favored value over technology. And, it almost feels like we're in a very similar spot. And what I hope people hear when you talk about the equal weight is just be aware that there's other ways to measure what's happening with the markets that are probably much healthier and more realistic of the broader picture.
So before we started the program today, you and I were talking about Charlie Munger, who passed away last year, and how much of a deep value guy Charlie Munger was. And he thinks that the price that you pay for a stock or the price that you pay for a company is really, really important. And so when we look at, the value stocks, you had price to earnings ratios down in single digits, right? And I saw some down as low as 5 or 6 times next year's earnings. That's a discount. That's cheap relative to where a company should be valued. And then you take the top 7, and the average price to earnings ratio on those is 45. And so you're paying 8 times more for that company than you would be the value company. So then that begs the question, and this is where I think we can get into our predictions for 2024. Is value going to be the place to be in 2024, or should we stay on that tech bandwagon and assume that we're going to get similar type returns that we did in 2023?
Yeah. So, back to Charlie Munger and, the partner with Warren Buffett, and we all know the success that they've had with Berkshire over the years and a number of other investment firms as well. Munger's been in the game for quite some time, but really a value guy at heart that is going to look at the price of the company and really determine long-term. Right. This is what's funny to me, Dean, is when I started in this business in 2004, right, long-term to me meant 25 to 30 years. If you ask anybody that is investing today, what's long-term, I would bet that you would not get more than 3 to 5 years in it. Yeah. And I throw caution to that because if you look at the success of what Munger and Buffett did, it didn't happen in the first 20 years. It happened in year 20 to about 30 is where a lot of their early investments, right? These are long-term companies that they bought they bought at a good price and they helped grow and they built them. And all of a sudden, 25, 30 years later, these guys have built maybe one of the largest and most influential investment firms out there. And so I think there's a loss of patience. And, when I think about the new year, what are things that you're working on? Patience is always one that's on my list because I'm terrible at it. I'm not here to criticize those that think long-term is 3 to 5 because mine is probably 3 to 5 days and I'm going crazy. So I'm not here to point fingers, but at the same time, patience is a virtue when it comes to investing. And, as we get into predictions and talking about what we think for 2024, I love it because at the end of the year, everyone wants to be, the person that says, "Oh, I was told you this is where we needed to be and what we needed to do." Well, guess what? We have a blank sheet in front of us.
Right. And we don't have the Las Vegas odds makers here to tell us, what's going to be the best asset class for 2024. You got when you enter into, football season or you enter into basketball or baseball, Vegas is making the odds of what team's going to win the championship, right? And you can kind of see, well, what are the chances according to the Vegas odds makers? You and I have to look at this from a fundamental standpoint, and this doesn't mean that we're going to say, here's our top picks, go put your money here. Still think the diversified portfolio is the right way to go, because when you look over time, the most important determining factor of return over time is asset allocation. It's not stock picking.
That's right.
Right?
Yeah, and I think that's the proper disclosure here. We're not here to make predictions or bets. It's the way that we think about risk is in a well-diversified approach to putting exposures out across a number of asset classes, including bonds, including domestic equities, international equities, thinking about alternatives. And really, I think the purpose of kind of creating an outlook here is back to your original statement. When you have a tech category that is, north of 45 PE ratio, and we're talking about what are fundamentals and valuations telling us at the beginning of the year, it can help guide us in terms of where do we think the opportunity exists. And I think as we start this discussion, we're going to learn very quickly that tapping into opportunity does not negate the role and the importance of still having a balance of offset and making sure that you're finding good diversification across your entire portfolio.
So let's start off with 2024 predictions, and we'll just run through a few categories, and these are going to be pretty broad categories. I don't know, you can get into more defined categories if you want to, but let's just start with growth versus value. And we'll start with large cap growth versus large cap value. Who wins 2024?
So if I look at the tail end of 2023, I was very impressed, and I think you were alluding to it within the return on the kind of equal weight versus the total return. But if you look under the hood of the recovery at the tail end of 2023, it was a much broader, more fundamentally driven rally, which is a positive thing for like value. All year, tech and growth outperformed value dramatically. And as I look at that, when you get those kind of moments of dislocation, then you go back and you start to say, what's the price of those tech names versus the value names? Where's the opportunity? So in this case, I would argue, I think value probably outperforms growth in 2024. But it's not that we don't want growth exposure. The way that we're looking at growth in this year is we want a broader exposure. Right, I don't want to go overweight those 7 names that are wildly elevated inside the price to earnings ratios. And I'm not saying we don't own them, right? I think owning them is still relevant, and
you just don't want those 7 to make up 25% of your portfolio.
I don't need them to dictate the entire role of my portfolio behavior in 2024. And it's a simple statement, and it's not a knock on Amazon. It's not a knock on Apple or Microsoft. I think these are phenomenal companies that need to be held. I just don't need them to be 25% of my portfolio, similar to what you're getting within some of the cap-weighted S&P 500 total return types of indexes.
All right, so I too choose value, and I like the high dividend type ETFs or individual stocks. If you're going to build a portfolio, I think value will have a good year in 2024, and I think it outperforms growth. Let's go to small cap. Small cap growth versus small cap value.
Growth versus value. I'm still going to lean on the value side, and that's where I see the biggest kind of discount in terms of valuations that are out there. But here's my disclaimer. Those valuations have been attractive for the last couple of years, and they have not been the winner, right? And so what I hope people hear with this is, again, you can have all the best information in front of you, and it still doesn't mean it's going to outperform. I'll give you a great example. I don't know if I should use their name. It's a company that rhymes with Angard. They have every year at the end of the year, they post their outlook for the upcoming year. For the last 12 years, they have predicted that international developed markets are going to outperform domestic equities.
And they haven't done it once.
And so we love the statement, right? Even a broken clock is right twice a day. Well, if they are wrong this year, their clock is only right once. So we'll see. And again, I'm not knocking them. Here's what's interesting is the valuations have suggested that developed markets have looked more attractive from a pricing perspective than domestic equities. But the reality is these names within the domestic equities have been so wildly robust that they've just continued to be able to outpace. So I use that as my sidestep to say I think small cap value outperforms small cap growth, and I'm leaning a little bit more on the cost to access capital within some of those smaller tech names and growth names that need to be able to have capital to promote growth. I think it's going to become more expensive. When you have higher rates, it's harder to tap into capital that way. I think it favors small cap value.
All right, so we got value, both the small and large cap. We both picked the same thing because I was in the same camp as you. Now let's go small cap versus large cap, small value versus large value.
Yeah, so again, these are great calls, great for conversation, right? What I want to be very clear is I still think that large cap needs to be a dominant portion of an overall asset allocation portfolio. What I will suggest is I think small caps should be finding increased weight to their portfolios. So it's not necessarily – I do think small caps outperform large caps this year. So I'll make a blanket statement and I'll live with it, right? I'll be happy to talk about why we're wrong, how we were wrong. I don't pretend to be the prophet of the markets. And as soon as you think that you are the prophet of the markets, get the heck out because you will be sobered up very, very quickly. But I do think that small caps are showing opportunities to be able to outperform, but it's not discounting the role that I think large caps need to continue to play in a well-diversified portfolio.
So you're saying you think there's a possibility that small cap value outperforms large value, but don't overweight it. Keep it in the right amount.
So we're going. So it's a it's about language here, right? We're going to overweight the existing position that we have, which is still a net underweight relative to what we have in large caps. So we're just saying, hey, I want a little bit more small cap than what I traditionally hold, but I still hold more large cap than I do small cap in an overall allocation.
Okay, so no, we're not playing the Monday morning quarterback, armchair quarterback here. We're actually saying what we believe 2024 has ahead of us, and we won't know until the end of the year. But let's move to your prediction for 2024 in the fixed income arena. Where do you think fixed income winds up at the end of the year? And let's just use the bond aggregate if we can. So total return for 2024 for the bond aggregate. I think you said this earlier, coupon plus 1 to 2.
Yep.
So you're saying maybe 6 to 7%.
Yeah, I would put us in, more conservatively about 4.5 to 6.5% is probably the range that we find bonds in. And again, these are just educated guesses as where we think they're going, but it's built around the back of the napkin math that suggests that the discounts that you're getting on average within the ag plus the coupon that you receive if you hold the maturity is suggesting we should be around that 5.5, 6.5%. And so I think that's a healthy range to be in.
Yeah, I would agree with that. And I think that, depending upon, where you find those opportunities and how you choose to purchase those fixed income securities, there's going to be some difference in that total return.
Yeah, and here's what's interesting is there is still a significant amount of money that's on what I'm going to define as the sideline, which is really just like a money market type of position, and rightfully so. Money markets are still paying well. I do believe that at some point in 24, we see a more significant rotation that finds a little bit more of that duration type of play or your ag-s type of exposure, if you will. There are a lot of people that are out there that have really started to buy the longer duration, treasuries. And so there's a part of me that likes it as the contrarian play. That long-term treasury is, has historically been a fantastic offset against some equities until it wasn't in 2022, and it got absolutely annihilated alongside of equities, and it took you down.
The longer treasuries actually lost more than the equity markets do.
Again, when you start to see this money moving out there, it makes you ask the question, what are they going after? And I think what they are seeing is the fundamentals of those longer term treasuries playing that role that we have seen of past of being more of the offset. That to me is still way too risky, and I don't believe that some of these that are coming from kind of that lower risk bucket of cash type of an alternative are going to jump right over the intermediates, which is probably the more notable step to be taking and go into long durations. But I'm telling you right now, if you're looking where the action is moving within just simple asset flow, long-term treasuries have picked up quite a bit, and even more so than intermediates. For me, I'm going to stay more in the intermediate space, and I'm going to stay high quality as we kind of work through if we're going to have recession or not.
Okay, so let's wrap it up with the discussion of recession or no recession. And what do you see? You see a recession in 24. You see no recession in 24.
I think so. If I look at the language of the Fed, we went from being very hawkish, right? We were raising rates. We were very hawkish to a little bit more of a dovish tone. And as you start to get that dovish tone, I think what markets are going to have to realize is that there is a slowdown that is happening within the overall economy. And this is what we call a Goldilocks environment, right? You don't really go from a strong growth market to recession overnight unless there's a true catalyst like global shutdown, which, holy crap, let's hope that never happens again.
doubt.
But typically you don't go from, strong growth to negative growth. So typically there's some steps that happen in between. I think in the early parts of 24, we're going to see the slowdown play out, which builds a case that we could see recession in the second half of the year. But I don't believe the recession is overly long-lived. So the depth duration conversation of that is not something that at this moment I'm overly scared of or frightened of. But I do think it's important to have good defensive posturing so that you can navigate through it. I mean, one of the early quotes that I think I learned from you you was it's not what you make, it's what you're able to keep through full market cycles that makes the biggest difference. And right now, we just came off of a really good, fourth quarter, and markets are doing well. How much of that are you really built to keep over the next 6 to 12 months? Or are you going to go buy the 45 PEs on all of the 7 tech names?
I'm not.
Well, I talked to you.
I already own some of them, but I'm not gonna buy any more.
I talked to you about my daughter, right? Who's turning 12, and we had a discussion around investing. And this is fantastic to see the brain of a 12-year-old try to digest investing. And I said, tell me names that you like. What do you think she picked? Well, it was the big 7 names that everyone knows. And I said, oh, great. So I went in there and I said, here, if you would have bought $2,000 of this stock 10 years ago, here's what it would have been worth. And then you try to educate that same 12-year-old, but here's a value stock name, right? Here's one that's good dividend, been around for decades. And the tech name wildly outperformed. So what do you think she wants? And this is the mindset of, I think, a lot of investors is we see the high shiny object up there within the tech and the growth and the 7 names, and I want to go be overweight to it. And it's very difficult to try to talk them down and talk about the role of it. But the way that I did it, Dean, was I went back to the lost decade, right? And we talk about how value behaved versus the growth in that time frame. And the further you go back, again, it comes back to not what you make, it's what you're able to keep. So trying to talk down a 12-year-old into making good, viable, fundamental decisions on stocks has been quite the task. And it's one that I'm actually looking forward to kind of documenting the journey with others.
That'll be fun.
Yeah.
Well, you call it recency bias, right?
It is.
And all right, so I want to cap off here by mentioning another individual who that's been on with the Guided Retirement Show here with me a few times, David Mitchell with AllianceBernstein. And David painted a picture the last time that he was on of 2024 saying, hey, there's kind of 2 potential outcomes for 2024. In a best case scenario, he was saying equities in the 10 to 13% range, fixed income in the 10 to 12% range. That's best case scenario. That's a soft landing. That's a Fed lowering rates later in the year. It kind of keeps everything even keel. Worst case scenario, he has equities down 10 to 15% and he has bonds flat. And that scenario is a scenario where we have an economy that actually goes into a recession, but inflation stays high, so the Fed's not able to cut rates. And that scenario would be a broadening of the war that's going on in Israel and the Gaza Strip right now, that Iran gets involved and it becomes a more global conflict. The U.S. gets involved. Energy prices go through the roof. We can't get rid of inflation because energy prices are high, yet we go into a mild recession. That's where he sees kind of the negatives. What do you think about that?
Well, so both paths feasible. Inflation to me is the primary driver. So Powell is a student of Volcker. Volcker was all about you kill inflation at all costs, which means if you need to go into recession to get rid of inflation, you go into recession and then you cut rates and you try to promote growth on the backside of it. And so I think Powell has done a fairly decent job. I mean, this is something that history is going to have to tell us, but so far I think he's done a pretty decent job. If inflation stays high and he has to continue to be aggressive on rates, I think the scenario of recession could play out. But here's what I heard of your entire dialogue of 2 different scenarios. Bonds are either up 10 to 12% or bonds are flat. And so what I heard in that is I think, and I hope investors, what you get out of this is not trying to be predictive of what the markets are going to do in the following year. It's fun. And I love it because everyone at the end of the year tells me what we should have been doing. But here, we put it on record. We put ourselves out there of what we think is going to happen. But at the end of the day, we really believe in diversity. And I believe in the role of asset classes over time. And what I heard in your story there is bonds more than likely play a more significant role than what we've seen of past. So diversity matters.
I would agree. And I think that let's cap this off with one final comment. If you started 2023 with a 60-40 portfolio and that was your ideal asset allocation, you're out of whack. You need to rebalance, and you need to sell off some of the equities, and you need to put more in fixed income so that you begin 2024 with that same 60-40 portfolio. Don't get greedy, right? Follow the fundamentals.
Yeah, don't get caught chasing. I mean, that's where you get pinched. Make sure that you understand the risk, and make sure that you're rebalancing back to what's appropriate for the risk that you're trying to take on.
Yeah. Brad, I certainly appreciate you joining me here on the Guided Retirement Show. Again, it's a fascinating conversation. I know you and I could sit and have this conversation a lot longer than what people want to listen. But thank you very much for joining me.
Not a problem. Always fun.
Thanks again for joining me here on the Guided Retirement Show. I hope you enjoyed my conversation with Brad Kasper. Please make sure you're subscribed to the Guided Retirement Show, whether you're watching us on YouTube or your favorite podcast app, and share this with your friends.
Starting your route to retirement.
Thanks for watching. Subscribe here to get the latest from the show. Also, be sure to leave a comment and share this episode with your friends.
Investment advisory services offered through Modern Wealth Management, LLC, an SEC-registered investment advisor.